Welcome to Wealth Talk. Happy Friday. Getting ready for 4th of July weekend. Exciting. Going to hang out with some of my good friends. Going to be doing some really cool things. And so it got me to think. A lot of people are following me because they want to do some cool things. They want to drive the cars of their dreams. They want to live in the place that they want. And what they're doing is trying to get information of how do we get there. So I went out to people on Instagram yesterday and said, hey, should I share with you how some of my friends got their money, how they got rich, or should we talk about some of the rules for new investors who are just starting to invest? They're trying to accumulate some wealth. And how much should you be doing things like putting money in long-term investments? Should you be trading the stock market? Should you be looking at speculative things like startup companies, distressed real estate? And if so, how much should we be allocating to those? So what I wanted to know is, do you want to know about that framework? And most people came back and said, yes, I want to know what are those rules? How do I get started? But today, what I'm going to do with you is share just a little bit about both of those on today's Wealth Talk. So look, going out to head with some very successful friends. Since this wasn't the primary topic, what I'm going to tell you is the vast majority of them got there through one of three things. Everybody I've worked with in my wealth management firm, all multimillionaires, got there one of three ways. Number one, professional athletes that signed really good contracts. For most of you, that's probably not an option unless you can hit a ball over a fence, you can run a 4.40. It's probably not going to happen for you today. So let me go to the next two. The other one is, which is a little bit more rare, is senior level corporate executives, people that have moved their way up through publicly traded companies and through the accumulation of company stock. Most of them who got in some really good companies, early technology companies, were able to amass over a long period of time stock options that became very, very valuable, that they sold over time and became multimillionaires. But by far, the vast majority of people that I work with, how I've accumulated the vast majority of my wealth has come through creating businesses, entrepreneurs, healthcare, technology, finance, blood, sweat, tears, and sacrifice, not working for somebody else, but starting your own thing, taking a tremendous amount of risk, mostly at a very early age. Some, like myself, starting businesses that failed before finally getting that business that took off and did well. So those of you who are thinking about starting your own business, I could tell you the vast majority of people that come to me to manage millions and millions of dollars, the vast majority of people that are friends of mine that have a lot of financial freedom and are able to do the things they want to do, they got there by starting their own business. So I can't tell you how much I support entrepreneurs and believe that everybody has the ability to create a successful business, create their own income stream, and live a life that they love. So with that being said, go out and start a business. But let's talk about the framework. I'm going to talk to you about a framework that I share with my clients. I share with these students in my Wealth Academy on how to incorporate this. And I myself use it for my own personal finances. And so I'm going to put it up on the screen here. It's basically this pyramid that starts out on the bottom, which is the base of your foundation. This is exactly where you should be putting the vast majority of your investments. We see that's from about 70 to 80%. And that's in your long-term investments. So let's talk about that. What are long-term investments? What I really like personally, when I'm thinking about long-term investments, is good, solid, cash flowing real estate, solid cash flowing corporations, assets that are paying me to sit home, assets that, when I go to my bank account every month, I have my account at Charles Schwab. One of my accounts every month sweeps dividends and puts it into my savings account. I see money come in there every month, primarily from blue chip stocks, traded real estate investment trusts. These are companies that I know have been around for a long time. These is not a recommendation, but they're companies like Procter & Gamble, Pepsi, boring companies. I own a real estate investment trust. Again, not a recommendation, WP Carey, 6% yield. These are companies that I know are going to be around, have very solid balance sheets, have very, very good strategy. They have great management, and they've been executing for a long period of time. At our wealth management firm, the things that I do in terms of screens, most of these stocks, for example, have been paying dividends for well over a decade, which includes the Great Recession when a lot of people were going out of business. Not only were they paying dividends, but one of the criteria I use in that investment approach is companies that actually raise their dividends year after year after year. So when I look at that and I look at my portfolio right now, I have companies that are paying me good income now. They're growing in terms of capital appreciation. And what I like is every single year when the new year starts and I look inside of my savings account, the money that's getting swept over from Schwab, it seems like that money goes up every single month. And that's because these are companies that are committed to a dividend and are paying that. So I really like building up that portfolio because ultimately, I think what we all want to do as investors, you've heard it before, is live off the interest. So if that's real estate income, so I talked about I have some real estate investment trusts. I know people out there have highly secured residential real estate or commercial real estate that they own themselves that they're collecting rents on, blue chip companies that they're collecting dividends. These are the things that you can count on. Capital appreciation is very difficult. Stocks go up and down, real estate prices go up and down. But what I like about cash flow, rents, dividend payments, those are consistent. And whether or not the stock market's going up, the real estate market's going up, those are things that I'm able to count on. So I like building the core part of my portfolio in those types of investments. Now, when you get up the scale to the next one, we talk about 20 to 25% being in trading. Now, I should say you could be maybe 5 to 10% on either side of this. So for myself, for example, I tend to be at about 15% allocation to trading. So what does trading mean? So if you're a real estate investor, this would be things like flips. You see an opportunity where maybe there's a distressed property, you're able to go in, put a little cosmetics on it, turn it around, put it in the market and realize a short-term gain on it. I do a lot of trading in terms of patterns. I talked about one of my favorite patterns on CrowdStrike just a few weeks ago. If you look back at that on my YouTube channel, I wait for patterns to set up in companies that I like, and I'm looking for short-term gains, 15, 20, 25%, based off of patterns that I trade all the time. So these are things that I'm looking very short term. I look at things like fear in the market. So when you look at last year, for example, COVID came, people panicked, they sold a lot of things. I didn't necessarily want to own all those stocks long term, but I knew that it was overdone. I used that fear to go in and buy some stocks. I waited until some of that fear got out of the market. We saw some more complacency, and I sold a lot of those stocks at a very good premium because I was able to capitalize on that. So these are things when you think about trading are more shorter term in nature, where you feel really good about the short term risk reward, but you might not necessarily want to own those for a long period of time. So those are things. What I would caution you though, is if you're going to go into trading, make sure that you have a solid foundation. I like to use technical analysis coupled with narrative, behavioral finance, and obviously the quantitative metrics of how does this company look in terms of a balance sheet? If I can see, oh, hey, based off of where this usually trades for the last 3 years, there's a 20 to 25% upside just to get back to parity. I like that. And qualitatively, are they able to execute on strategy? Those are some of the things I use. Now, if you're a real estate investor, though, make sure it's an area you know. Don't speculate in maybe some area just because it looks good, but you don't know anything about it. There's probably an area that you're focused on. There's a demographic, there's a price range that you've had consistency on going in, maybe add value and turning those properties around. So trading, just make sure you have a plan in place. Make sure you're consistent with that plan. You're not using emotion to guide your trades. You're not just hearing someone say, oh, go buy this stock or piece of real estate without a foundational set of rules to be able to go in and trade. If you're not able to do that, what I would recommend is you shift that percentage in the middle right back down to your long-term investments, because you're better off putting it in good, high-quality long-term investments that will over time appreciate versus trading on a whim or trading without any structural pattern in place. And then at the top of the pyramid, and again, 5% to either side, I tend to be about 15 to 20% on this top period because I put a little bit more on my base of long-term investments. Now, when you talk about speculative investments, so if it's 10, 15%, 5%, 0%, whatever that is for you, what I always tell people is when you're allocating money to this area of your portfolio, make sure that it's something that you can lose. Make sure this isn't the rent money, the mortgage money, the retirement fund, the children's education. This is money that if it goes to zero, it's not going to impact your quality of life. It's not going to impact your lifestyle, right? So these are things what I, again, have made the vast majority of my money investing in businesses, my own businesses, publicly traded businesses. I invest in startup businesses that are usually private businesses. If you're going to be investing in companies that are startup companies, there's a tremendous amount of risk associated with those. Number one, will they be able to get the funding they need? Is their strategy to be the right time at the right place? Are they going to be able to recruit the right talent? So even if you like the company, there's a tremendous amount of risk with startups, and we know that a lot of them fail. So you don't want to be all in on startup companies. However, the great opportunity with some of these is some of these are your moonshot types of companies, 10x, 20x, 30x rate of return. So a lot of people will tell you don't speculate. I'm here to tell you do speculate, go for those moonshots, allocate capital, especially when you're younger, to things that could really make a difference. Now, when you're investing in that bottom of the period, we know over a long period of time, if you're safe, you're going to do well with those. But at the top, those are the things that could really get you to that next level, that could sometimes be life-changing. But make sure that you're very careful with the analysis. Don't put more than what we're recommending here, and spread that out over a few different things. If you look at some of the best venture capital investors out there, like Andreessen Horowitz, they're spreading that amongst a portfolio of companies, because you never know which one's going to be the winner, and you want to be able to prepare for that risk. So when you look at this framework, it's giving you an idea. If you're looking to get to long-term wealth, you don't want to necessarily be everything in safe dividend paying stocks. You definitely don't want to be flipping or trading your portfolio on a daily basis. And you definitely don't want to be speculating with everything. But I think this is a good, healthy balance, again, with about a 5 to 10% range of how, especially for you younger investors who are coming to me now and say, how much should I put in this stock? How much should I put in real estate? This is a good framework that you can use when you're allocating capital. And I would make sure that you're allocating to all of these. So if you're somebody who's dollar cost averaging every month, maybe it's this. If you've got $10,000 that you're going to invest over the next year, get the first 70%, $7,000 of that into the sound foundation of your blue chip companies, some real estate investment trusts. And then as you grow, then start maybe doing a little trading, start finding some of those speculative, maybe you can invest in private companies at this age, but companies that are traded publicly that might be more speculative to give yourself some upside. That's a good way to do this. Now, one thing I'll talk about within this framework also, a lot of times people ask me, how much do you put into any one stock? I have a rule for that. I never put more than 5% in any one stock. So the rule is I never necessarily put as much into a stock where I can make a total killing by it, but I never want to get killed by it either. And that's one of the things that I see time and time again. People allocate too much money to one individual stock, and when things don't work out, what do? They say the stock market doesn't work, they give up, and they're back to square one. So I don't want to see anyone do that. So this is the framework I wanted to share with everybody, an idea of when you look at your own portfolio today, how much do you have in speculative capital? How much are you trading in the portfolio, and how much do you have in long-term investments? This is to give you an idea to think, if you're way out of whack with this, it's probably time that you start rethinking that, because the key to building solid long-term wealth is taking a long-term perspective. It is taking risk. I want to say that it is taking some speculative risk and putting some allocate there. If you have the wherewithal and the knowledge to be able to trade, taking advantage of when people panic, when there's fear in the market, even when there's greed in the market, to going against the grain and trying to capitalize on that. And for most of you, it's that long-term foundation of solid companies that you're buying for the long term, that are market leaders, blue chip companies that are going to pay you some income to hold those. And the same thing for real estate investors. So at the end of the day, I hope this gives you some framework of how you should start thinking about your investing, how you should speculate, how you should trade, how you should be buying long-term investments, because this is the way that you're going to get to creating the wealth that you want, the income that you want, and living a life that you love. Thanks. That's it for Wealth Talk. If you like this, please subscribe to my channel, click the button below, the bell below, you'll get notified every week. And please share my channel. I do this every week. I've been managing money for over 23 years for some of the world's wealthiest investors. This is a way for me to share some of the knowledge, information with you so that you can control your own financial destiny. Thanks and have a great week.